What if your government offered to just step in and absorb the first 20% of your investment losses, simply so you'd help fund the nation's technological future?
I mean, it sounds like some kind of theoretical exercise in behavioral economics. You're essentially weaving a sovereign financial safety net directly into the, high stakes, highly volatile world of venture capital.
It really does sound totally theoretical, but it's actually happening right now. Welcome to the Career Research Channel and our deep dive today.
And before we get started, just a quick reminder to like this video and subscribe to the channel if you enjoyed this kind of content.
Yes, please do.
Right.
So the date is May 2026, and South Korea's Financial Services Commission has just unveiled a policy that's, well, it's capturing the attention of institutional and retail investors globally.
Yeah, it's officially called the People's Participation Growth Fund, or the Gukman Growth Fund locally.
Exactly. And our mission for this deep dive is to unpack exactly how this fund works, where the money is actually going, and why South Korea is effectively trying to crowdsource its industrial policy.
What's fascinating here is the structural ambition. Like, this is a highly engineered attempt by a state actor to democratize access to strategic asset classes.
Asset classes that are usually totally waste off.
We're talking about the kind of early-stage, capital-intensive private equity that's traditionally reserved for sovereign wealth funds, giant endowments, or, ultra-high net worth individuals.
Because of the massive risk involved. I mean, early stage VC is notoriously binary. Startups either achieve massive scale or they just go to zero.
Right, and for decades, the average Korean citizen has contributed to their country's rise as a tech superpower. But, their investment access has mostly been limited to buying shares of massive, already matured conglomerates on the public market.
Yeah, so they missed that explosive growth curve entirely.
Precisely. They've watched their domestic semiconductor, AI, and secondary battery sectors dominate global supply chains. But the wealth generated during the private formative years of those startups.
It just bypassed the broader public completely.
Exactly. The mandate of this new fund is to bridge that exact divide.
But to do that, you have to solve for the retail investor's ultimate fear, which is losing money, downside volatility.
Yeah, you have to mathematically alter the risk-reward ratio if you want everyday people allocating their surplus capital into futuristic deep tech startups.
Okay, let's unpack this with the actual numbers. The state is aiming to raise 600 billion won from the public, but they are seeding the vehicle with an additional 120 billion won in government funds.
Right, creating a total operating pool of roughly 720 billion won.
And how that 120 billion won functions is key here.
Right, we need to be very precise about that. It's not a proportional matching contribution.
It doesn't sit side by side with the retail money.
No, not at all. It has a deeply specific subordinate structural role. It's basically designed to act as the first line of defense.
So I love the analogy the government is using for this because the financial engineering here is brilliant. Think of this 720 billion won fund as a car, and the state has welded a massive, heavily reinforced bumper to the front of it.
That's a great way to visualize it.
Because in a standard mutual fund or ETF, if the underlying assets drop by 15%, you, the investor, feel the impact instantly. Your portfolio value just drops by 15%.
You absorb the absolute undiluted shock of the market movement.
Right. But with the Gukman Growth Fund, that 120 billion won of state capital operates as the bumper.
Yes, the public funds are structurally subordinated to bear losses first, up to a 20% range within the sub-funds.
So if the broader tech market contracts and the sub-fund takes a 15% hit, that government bumper crumples.
Exactly. It absorbs the blow completely, and the ordinary investor's principal remains intact on paper.
But wait, I need to push back on this a bit because this doesn't guarantee the principal, right? If the market totally crashes, that bumper just falls off.
Oh, absolutely. That is a critical point. The bumper is a cushion. It's definitely not a concrete floor.
Right, because we're talking about sectors tied to global macroeconomic cycles.
Exactly. If a sub-fund suffers a catastrophic drawdown of, say, 30%, the state capital is entirely wiped out at the 20% mark.
Wow, okay. And that remaining 10% loss?
It bleeds directly into the retail investor's principal. So it's vital to understand that this mechanism reduces the probability of a minor loss, but it doesn't eliminate the possibility of a severe one.
Right, but psychologically, truncating that initial 20% downside gives retail investors the courage to step into volatility they'd normally avoid.
Precisely, it alters the baseline psychology.
Okay, so if we look past the bumper, Where is this 720 billion won actually driving? What are we investing in?
It's being injected into the arteries of South Korea's future industrial base. The policy specifies target sectors like artificial intelligence, semiconductors, secondary batteries, advanced biotech, robotics.
And defense, right.
Yes, and defense.
And we should contextualize why these specific sectors are named. Like, these aren't just trendy buzzwords meant to attract retail capital.
No, not at all. This is a map of global geopolitical leverage. Semiconductors are the foundation of national security. Secondary batteries dictate the future of automotive markets.
Right. Maintaining a competitive edge in these arenas is quite literally a matter of sovereign economic survival for South Korea.
And historically, they've relied on a handful of massive conglomerates to carry that edge. But the global innovation cycle has accelerated so much.
Massive corporations just can't pivot fast enough on their own anymore.
Exactly. The true disruptive innovation in deep tech is happening at the grassroots level within private, highly specialized small and mid-sized enterprises, or SMEs.
Which brings up this concept that's central to this whole thing, the Valley of Death.
Ah, yes, the Valley of Death.
It's basically this massive lethal funding gap, right? Between proving a concept in a laboratory and actually having the capital to manufacture that concept at scale.
That's the exact mechanism, yes. And it's particularly brutal in deep tech.
Because if you're building a consumer software app,
Server space is cheap.
but if you're a robotics company that just perfected a new actuator, or a biotech firm moving to clinical trials, your capital expenditure requirements suddenly explode.
You need factories, clean rooms, specialized supply chains, and traditional banks won't fund pre-revenue startups. They want to see historical cash flows.
Ah, so what does this all mean for the listener?
It means the government is recognizing a market failure in capital allocation and stepping in to bridge that canyon.
So instead of you trying to pick the one winning AI startup out of hundreds, the government has hired 10 professional sub-fund managers to do the heavy lifting for you.
Precisely. They ran a rigorous screening process to select private sector fund managers who actually specialize in these target sectors.
So you get the diversification of 10 different strategic portfolios, wrapped in the state's 20% loss absorption bumper.
It's a very powerful proposition.
It really is. So let's pivot to logistics. Because looking at the structure, there is a very deliberate frenzy engineered around the rollout.
Oh, absolutely. The primary logistical feature is the incredibly narrow window of opportunity.
Right. It opens on May 22, 2026, and definitively closes just 3 weeks later on June 11.
And it operates on a strict first-come, first-served basis across 25 authorized financial institutions. That's 10 major banks and 15 securities firms.
First come, first served on a national level, which implies that if the 600 billion won retail allocation hits its cap by day 8, the doors lock immediately.
Yes. You can subscribe through a traditional branch visit or a mobile app, but there is a massive incentive to make sure your account is structured properly.
Because of the tax perks, right? They're arguably just as valuable as the loss bumper.
The tax alpha is substantial. If you meet the basic eligibility, which is being 19 years of age, or 15 if you have earned income, you unlock income tax deductions. But the real anchor is the second benefit.
The flat 9% separate taxation on dividend income. We really need to explain why this is such a massive draw.
Right. So normally, if you make a significant profit from investments, that dividend income is aggregated with your salary.
Which pushes you into a comprehensive financial income tax bracket.
Exactly. And that can carry a marginal rate well over 40% depending on your total income.
Wow. But with this fund,
For 5 full years, any dividend income generated by the fund is taxed at a flat 9%, completely isolated from your comprehensive bracket.
that spread from over 40% down to 9% is a huge yield enhancement for the investor.
It supercharges the upside. But the state is fully aware of how lucrative this is, which is why they imposed aggressive caps.
Right, 100 million won per person on an annual basis, capping out at 200 million won total over 5 years.
And they explicitly exclude anyone who has been subject to comprehensive financial income taxation in the 3 preceding years.
So they're keeping out the whales. They don't want billionaires monopolizing this just to harvest the tax benefits.
Exactly. They are surgically removing the ultra-wealthy to preserve the allocation for the middle and working classes.
And if we connect this to the bigger picture, there's a fascinating social equity angle here too.
Yeah, for the first 2 weeks, May 22 to June 4, An absolute minimum of 20% of the total retail allocation is strictly reserved for lower-income investors.
Which proves the policy goal isn't just making rich people richer.
Right. By broadening the capital base and distributing the potential wealth generation across lower and middle income brackets, the state is attempting to boost future domestic consumption.
It is a meticulously designed wealth distribution mechanism disguised as a venture fund.
It truly is.
However, let's look at the trade-off here. We've talked about the safety net, the tax alpha, the strategic assets. If this sounds like a financial panacea, here's where it gets really interesting.
Ah, yes. The friction.
There is a massive catch to this fund, and it is something you must absolutely understand before committing a single one.
We are talking about the total sacrifice of liquidity.
Right. The Guckman Growth Fund is a 5-year closed-end fund, meaning no early withdrawals.
None.
If you put your money in on May 22, 2026, you cannot log into your brokerage app in November of 2027 and just cash out because you changed your mind. Your capital is locked in a vault for 5 years.
Now, the mechanics do technically allow for the fund to be listed on an exchange, theoretically creating a secondary market.
But because the underlying assets are highly illiquid private companies, trading volume is going to be anemic.
Right. If you are forced to sell your shares to another buyer, you'll take a massive haircut. You'll be selling at a steep discount.
So, and I want to speak directly to you listening. Do not put your wedding budget in this fund. Do not put your rent deposit or next year's university tuition into this.
It is strictly for medium to long-term surplus capital. It is not an emergency fund.
But there is a reason for that lockup, right? It connects directly back to the Valley of Death.
Exactly. The core function of this fund is to provide patient capital to deep tech SMEs.
Right. You can't fund the construction of a semiconductor clean room with flighty capital.
If retail investors got spooked by a geopolitical headline and demanded their cash back, the fund manager would be forced to liquidate half-built clean rooms.
Which would bankrupt the exact strategic companies the policy was designed to protect.
Right. The illiquidity is not a bug. It is the load-bearing pillar that makes the entire strategy possible.
You are trading your liquidity for the state's downside protection and tax alpha. That is the fundamental social contract here.
It forces retail investors to behave like institutional venture capitalists. It demands patience.
So, synthesizing everything we've unpacked today, the People's Participation Growth Fund is a rare blend of national industrial strategy and household wealth building.
It mitigates the fear of early-stage volatility, uses tax architecture to favor the middle class, and demands strict illiquidity to cross the Valley of Death.
Which leaves us with a truly provocative question to ponder.
What's that?
If South Korea successfully bridges the gap between state-level tech ambitions and everyday citizens' wallets, will other countries around the world have to adopt this exact same public participation model?
Just to stay competitive in the global AI and semiconductor race.
Exactly. Will we see the United States or the European Union forced to offer this kind of government loss absorption